Hello and welcome to another Global Macro Update. As always, going to kick things off with a quick summary of some of the stories I'll be getting into today, starting with, of course, the Fed raising interest rates by 75 basis points.
Yep.
President Legarde of the ECB raises the prospect of a restrictive terminal rate. Putin mobilizes more troops for the war in Ukraine and keeps the nuclear option on the table. Japan posted a record trade deficit, and its inflation hit a near 8-year high.
God damn!
BlackRock praised the EU's labeling of natural gas as green.
Say what?
The UK announced a price cap on energy for businesses.
Not crazy.
And the White House released a comprehensive framework for digital assets.
My man!
But before I get into all that, let's go over a quick recap of last week. So, US inflation numbers came in higher than expected at 8.3% for headline and 6.3% for core.
For real? You fuck with that?
No, we do not. The ECB raised rates by 75 basis points, and President Legarde painted a very unpleasant picture, to say the least. European energy companies secured bailout money from the government. Canada announced an inflation relief package.
You're a fucking idiot.
The IMF discussed issuing emergency food aid to struggling economies.
Whoa.
And Charles Schwab, Citadel, and Fidelity are launching a crypto exchange. All right, with that out of the way, let's jump into the stories for this week, starting with, the Fed raising interest rates. So, just getting right into it. Recent indicators point to modest growth in spending and production. Job gains have been robust in recent months, and the unemployment rate has remained low. Inflation remained elevated, reflecting supply and demand imbalances related to the pandemic, higher food and energy prices, and broader price pressures. The committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. Honestly, this is all pretty much just reiterating everything they've been saying. I'll offer some, a little minor commentary at the end, but let's just continue. In support of these goals, the committee decided to raise the target range for the federal funds rate by 75 basis points and anticipates that ongoing increases in the target range will be appropriate.
Totally.
In addition, the committee will continue reducing its holdings of Treasury securities and agency debt and agency mortgage-backed securities.
Say what?
As described in the plans for reducing the size of the Federal Reserve's balance sheet that were issued in May, the committee is strongly committed to returning inflation to its 2% objective. In assessing the appropriate stance of monetary policy, the committee will continue to monitor the implications of incoming information for the economic outlook.
Right.
The committee will be prepared to adjust the stance of monetary policy as appropriate if risks emerge that could impede the attainment of the committee's goals. The committee's assessments will take into account a wide range of information, including readings on public health, labor market conditions, inflation pressures and inflation expectations, and financial and international developments. So this isn't these aren't the highlights from the actual speech that Powell delivered, but I did watch it, so I can offer a little bit of commentary. I would say the main takeaways are that the Fed is toying with a terminal rate, meaning the highest rate that the Fed funds will reach at about 4.5%. I believe the committee is somewhat torn. I can't remember the exact numbers. It's like 13 of the 19 or something like that of the Fed chair members are basically split between 100 more basis points and 125 more basis points until reaching the terminal rate. And then the other takeaway would be that they are, and this is actually one of the questions that was asked to Powell after he gave his speech, and that was about quantitative tightening and its effect on interest rates, because part of the quantitative tightening is basically selling agency mortgage-backed securities. And when you sell those, that puts upward pressure on rates, mortgage rates specifically, which are already at 6%. So that is not good if you are worried about interest rates already, which most people are because of the way they've skyrocketed higher.
Totally.
Now, Powell basically said that that is not a consideration in the meantime. He didn't rule it out saying that it doesn't matter, but he did mention that the committee isn't really concerned about that right now. They are going to continue their plans for quantitative tightening, which I believe they're already doing it right now, but that is going to increase for mortgage-backed securities to, I believe, $17.5 billion per month starting in October, because the first 3 months they were doing a total of $30 billion in quantitative tightening. That includes treasuries and mortgage-backed securities. And then in October, they are going to increase just the mortgage-backed security part of that to $17.5 billion. And the total would be $60 billion for both treasuries and mortgage-backed securities.
My man.
But yeah, those are the main takeaways. I still encourage you guys to check out the actual speech, because you never know. There's always something you miss. All right, let's transition to the next story. So, kind of in the same vein as what we were just talking about, forecast for Fed terminal rate hits a new high. So, expectations of how aggressively the Federal Reserve will raise rates in its fight against inflation hit a fresh high this week, exacerbating pressures on stocks and bonds. As investors await another jumbo rate increase, I love their technical terms, jumbo rate increase from the U.S. Central Bank at its September 21st meeting, higher than expected inflation numbers have ramped up bets on the so-called terminal rate, which now stands at 4.45%.
God damn.
Definitely way higher than it was previously, and honestly just keeps going up. So important to watch, because that is basically the level the market is predicting interest rates will peak, or like Fed funds will peak, which is significant because every interest rate for the most part is derivative of the Fed funds rate. So if that keeps going up, other interest rates like the mortgage rate are going to rise, roughly commensurate amount.
Totally.
All right, so that is more than 200 basis points higher than the current benchmark overnight interest rate, and compares with a projected peak of about 3.7% just a month ago. So this is constantly evolving. Obviously, it has to do with inflation and every Fed meeting, them being more hawkish or dovish. But basically, those projections have been going nowhere but up in the most recent month or past few weeks. So as a quote, I think the Fed is going to put another 150 basis points to 200 basis points, so 2 full percentage points of rate hikes into the market. But it's the speed with which they do it, which is the debate at this point. So the Fed has basically been taking the approach of front-loading rate hikes, which means they're trying to load up as many as they can in the beginning to reach a terminal rate faster, and then keep rates in that restrictive territory for some time. So not necessarily raising 25 basis points every meeting for half a year, but really trying to front load all those rate hikes, probably to kind of manage expectations largely, because they just want to scare people. Inflation's going down, you're going to be unemployed, get your money out. Just, that's kind of the idea behind front loading, is basically just inflicting max pain right away. That way it squashes inflation, or at least hopefully quickly, rather than this kind of slow burn of small interest rate hikes. All right, so yields on the 10-year Treasury inflation-protected securities, known as real yields because they strip out projected inflation, climbed to 1.03% on Friday, their highest since January 2019. Meanwhile, benchmark 10-year Treasury yields have climbed about 8 basis points this week to 3.443%. I believe they actually cleared over 3.5%, which is pretty substantial. I mean, if they get to 4%, that'll be wild. Which, if they're supposed to match the terminal rate, obviously that would happen. But, we're seeing a lot of inversion in the curve right now. So if the 10-year is lower than the Fed funds rate, that will be wild.
Not crazy.
Anyway, so the 10-year Treasury is flirting with a new 11-year high if they go above 3.495%, which, like I said, I'm pretty sure they did. So we've already reached that 11-year high. The picture is not any rosier for corporate debt. So one of the interest rates that is heavily affected by the Fed's policy is corporate spreads, credit ratings, what different corporations can, their cost of capital when they issue debt. If they're, AAA rated or BBB rated, CCC rated, they have different costs of capital associated with that. And a health of the economy, or a good metric for the health of the economy, is those spreads, basically between the Fed funds rate, or like the reverse repo rate, and corporate bond rates or yields. So like AAA, I believe, is around like 5% right now. And then you got like high yield, CCC or lower is like over 15%. But those spreads widen basically. So even though they may go up with the Fed funds or reverse repo rate increasing, with the Fed increasing interest rates, they may increase at a faster rate, thereby widening that spread.
That's what she said.
Which is not good. So investors don't appear to have much confidence in the Fed's ability to engineer a so-called soft or not so hard landing. A swift rise in real rates is generally bad for spreads when growth is below trend, Barclays strategists said in a note on Friday. And they do not think that this time will be different. Words to live by in the investment world, right? All right, yeah, so bottom line, the Fed is raising rates, and the terminal rate, the rate at which they're going to stop, basically, the peak, has also been going up, and the forecast right now is about, for a lot of people, it's up in the air, obviously, but 4.25%, maybe like 4.5%, which is obviously significantly higher than where we are right now. So, we got another, I believe the market is anticipating another 75 basis point hike at the next meeting, like 6 weeks from now. And then maybe like a 50 after that, in the subsequent meeting. And then the meeting following that, maybe about 25 basis points. But think about all these as basically plus or minus 25 basis points. And it will really depend on inflation prints to come, job growth, all these different factors that the Fed considers.
Totally.
All right, transitioning. Okay, so big story. There's actually two related to housing that I will get into, but starting with this one. So more home builders lower prices as sentiment falls for the 9th straight month. So more builders are lowering prices for homes as their confidence in the market continues to tumble. Home builder sentiment in September fell 3 points to 46 in the National Association of Home Builders Wells Fargo Housing Market Index. That's a mouthful.
That's what she said.
And anything below 50 is considered negative. So 46 is obviously below 50. So we're in negative territory. That is the 9th straight month of declines and the lowest level since May of 2014, with the exception of a short-lived drop at the start of the coronavirus pandemic in 2020. Sentiment was at 83 in January of this year, when interest rates were about half of what they are now. So we made a fast drop to 83, from 83 to 46. And as you can imagine, that is honestly almost like equivalent to the rise in interest rates. I mean, 83, you got almost, because we've almost doubled interest rates, right? And so that sentiment has basically halved. So about a commensurate amount. Now, the average on the 30-year fixed mortgage started this year around 3% and then began rising steadily, crossing 6% for a few days in June. I believe it's still there at 6.02 last time I checked.
My man.
That made an already pricey housing market even less affordable. The Federal Reserve, meanwhile, is expected to again raise its benchmark rate this week, which was today, as inflation remains high. So they certainly did raise rates. Buyer traffic is weak in many markets as more consumers remain on the sidelines due to high mortgage rates and home prices that are putting a new home purchase out of financial reach for many households.
Aww.
Nearly a quarter of home builders also reported lowering home prices, up from 19% in August. Builders continue to report elevated construction costs in addition to higher interest rates weighing on their market. Higher costs for land, labor, and materials have made it harder for builders to lower prices, but they are now being forced to. So one of the things about raising interest rates is it has encouraged less inventory from coming online, less supply, just because it's so expensive. Nobody wants to buy a house, but you're obviously also killing demand. So it's kind of this battle of, which is going to be stronger. It's all about relative terms, right? So is the demand, as in people not being able to afford houses and, going out there and bidding them up, going to be more of a factor than the inventory or supply coming down because people don't have the motivation to make houses when nobody's buying them. I mean, if nobody's buying houses, why do you want to make more? And so that can kind of constrain supply. It still seems like housing is probably going to head a little bit lower, at least in the meantime, just given the interest rates really affecting people's willingness to buy a home. But definitely keep in mind the supply side of this, because that is important. And inventory was already pretty tight, so if interest rates are discouraging people from adding more houses to the supply, then that's going to be a huge factor. All right, and then final bit, on a 3-month moving average, sentiment in the Northeast fell 5 points to 51 and also dropped 5 points to 44 in the Midwest. In the South, it slipped 7 points to 56, and in the West, where home prices are highest, sentiment declined 10 points to 41. It's a pretty steep drop, which is probably warranted given California or just West Coast prices are astronomical.
Damn!
All right, so next housing stories will be a quick one. All right, so existing home sales in the U.S. edged 0.4% lower to a seasonally adjusted annual rate of 4.8 million in August. And the lowest reading, it was the lowest reading since May of 2020, and following a downwardly revised 5.7% drop in July. It marks the 7th consecutive month of falls in existing home sales, reflecting this year's escalating mortgage rates. The median existing home sales price rose 7.7% from 1 year ago to $389,500. So despite all this going on, year over year, housing prices, or the median housing price, has actually gone up.
Not crazy.
It's pretty wild. After 5 successive monthly increases, the inventory of unsold existing homes dwindled to 1.28 million, or the equivalent of 3.2 months at the current monthly sales pace. Sales rose in the Northeast 1.6% and the West 1.1%, but were unchanged in the South and fell 3.3% in the Midwest. And for anyone watching, you can see this chart of the home sales. So they were pretty aggressively high. Maybe not aggressively high, but they were very high in the previous months, especially prior to January of 2022. But we have been on, ever since January, a pretty staircase-like decline till today. And the previous month was about the same, but you can still tell that we are seeing a huge decline in home sales overall.
Yep.
All right, next story. Okay, so this is kind of a big deal. So the BIS backs forceful rate hikes despite rising recession risks. So all of these central banks, and I mean the BIS isn't a central bank, but they kind of influence things. They're the Bank of International Settlements, and they're kind of it's kind of like I guess maybe an apt comparison, if you're familiar, is the IMF, just one of these global organizations that has a lot of influence on just global monetary policy in general.
Totally.
So the BIS backs forceful rate hikes. They're basically encouraging people to push forward with rate hikes despite any of these recession fears that people are anticipating on the horizon. So the world's central bank umbrella body, the Bank for International Settlements, has urged major economies to forge ahead with forceful interest rate hikes despite the growing threat of recession and currency market volatility.
You're a fucking idiot.
The Switzerland-based Bank of International Settlement quarterly report acknowledged that both recession and debt risks were rising, but said that bringing soaring global inflation back down remained paramount. It's important to act in a timely and forceful way. Front-loading of rate hikes tends to reduce the likelihood of a hard landing.
Right.
Now, I'm not sure if they're basing that off of any data. I mean, maybe it's true, but I feel like that's very convenient just because all the central banks are front-loading. That's what they want to do, but I digress. So what makes it particularly complex is that this is the first time since at least World War II when policymakers are trying to tackle soaring inflation at a time when debt crises are already breaking out and when serious worries exist about overpriced property markets. This time is different. On top of that, growth forecasts have continued to be revised down, whereas inflation forecasts have continued to rise.
Go!
So both obviously going in the opposite direction people want them to. We know that the path is quite narrow. Clearly, if there was a risk of recession before, the risk has increased. A special section of the BIS report also pointed to the potential for further trouble ahead. It warned that replacing Russian oil would be difficult given the limited spare capacity of other major producers and subdued investments in new projects. That could lead to persistent price rises in oil-related goods, while the leap in natural gas prices could have a large and protracted impact on electricity prices and provide a major headwind to industrial production. Outside the United States, the surge in the dollar is adding to inflation problems and also piling pressure on lesser developed countries who have borrowed heavily in dollars but now struggle to pay the money back as their own currencies crater. So this has actually been a big problem, part of the dollar wrecking ball. The DXY edging higher. All these countries that have dollar-denominated debts, which is most countries, just because the dollar is the global reserve currency. So, it's what everything's priced in globally, like commodities, food, things like that, energy. And so you take out dollar-denominated debt, the dollar goes higher relative to your respective currency, and that basically means your debt is going higher. So you're basically getting squeezed, you can have margin calls, and that's why a lot of these countries that are heavily indebted are struggling a lot right now. And potentially why you're going to see a lot of, maybe sovereign defaults for some of these, I guess, less developed economies that don't have the ability to weather that, don't have the reserves to defend their pegs, their currency, or, there's a lot of reasons. But basically, they're getting squeezed right now as the dollar rises, which I believe actually reached another high today, maybe touching like 111, which is wild.
Not crazy.
So that could lead to persistent price rises in oil-related goods, while the leap in natural gas prices could have a large and... Oh, I already read that.
You're a fucking idiot.
So this could put some further pressure to tighten monetary policy to prevent a big depreciation, and could also induce, as an additional tool, foreign currency intervention, as it has already in a number of countries. So part of... the squeeze, like I kind of alluded to, is the pressure it puts on people's currency or nation's currency. And that's why we're seeing a lot of currencies just go wild. I mean, the Japanese yen, the most obvious, where it's to date, depreciated like 25-30% relative to the dollar. And there's been a lot of talk about whether or not they're going to defend some rate. The Chinese yuan has also been under pressure, depreciating pretty rapidly against the dollar. They have plenty of reserves to defend the peg if they want to for some period of time, but obviously they don't have a limited amount of reserves, so they can't do that indefinitely.
Totally.
But yeah, here's actually a really good chart right here of all the currencies year to date that have how they have performed relative to the dollar. So only 3 currencies year to date have outperformed the dollar, and that is the Russian ruble, which is by far number 1, the Brazilian real, and the Mexican peso. But every other currency has depreciated against the dollar in relative terms. So basically, all the currencies except those 3 that I mentioned have been losing against the dollar. So all these countries that have dollar-denominated debts, their debts are becoming larger in absolute terms, which is not good. All right, let's transition though. So next story, the ECB President Legarde raises prospect of rate hikes beyond neutral level. So before I get into it, let me add some context, I guess. So neutral level basically means the level at which interest rates or monetary policy is neither accommodative nor restrictive. What? So most central banks, or maybe not most, but a lot of the central banks, the Fed in particular, they are aiming to move to restrictive territory because they're trying to, reduce inflation or cut inflation back. And a neutral rate wouldn't necessarily do that. But they have their own means for establishing what they believe that neutral rate is. And the ECB, I believe, prior to this was planning on just moving to neutral, not necessarily restrictive territory, meaning higher rates than the neutral rate. So say their neutral rate was like 2%, they're going to move to 2.5% or 3% or something like that. So she's basically floating the idea that the ECB is going to move to restrictive territory, which means more rate hikes. So the European Central Bank may need to raise interest rates to a level that restricts economic growth in order to cool demand and combat unacceptably high inflation. The ECB has been raising rates at the fastest pace on record, but inflation is still rising, and even longer-term expectations, a key focus for policymakers, are starting to move above the bank's 2% target.
No!
And we know how much the banks care about their expectations. Inflation expectations is everything to them. If there were evidence that high inflation risk de-anchoring inflation expectations, then the policy rate that is compatible with our target would lie in restrictive territory. So basically, if inflation expectations continue to de-anchor or basically just move beyond the 2% target rate, so if 5-year expectations are 3%, 4%, whatever they may be, then that will motivate the ECB to continue on, or I guess change their policy to end with a restrictive territory interest rate, like the terminal rate being in restrictive territory. So it's all kind of, at least according to this, dependent on inflation expectations. Policymakers have talked about pausing rate hikes once the ECB hits the so-called neutral level that neither stimulates nor holds back growth, but a growing number of rate setters now see the risks that rates will have to go higher.
Oh, hell no!
So the nominal neutral rate is seen somewhere between 1.5% and 2%, well above the ECB's current 75 basis points. Again, they were starting from negative territory, actually. So I remember their first rate hike was pushing to zero because they were negative. I think it was like negative 50 basis points or something like that. And their first rate hike was to get back to 0%. So they have a long way to go, but their neutral rate is expected to be 1.5 to 2%. Current rate, 75 basis points. So at the very least, they have another 75 to full percentage point, or 125 basis points in store just to get to the neutral rate. And now they're talking about going beyond that to possibly maybe 2.5%. So while Legarde said medium-term expectations were relatively well anchored around the target, it would be unwise to take this for granted. The ECB president, however, provided no clues about the October rate hike and only repeated that the ECB will decide its next moves meeting by meeting. So, like most of the other central banks, they're going to be data dependent. And last bit, investors are currently split between a 50 and 75 basis point rate hike in October, with subsequent increases seen at every meeting through next spring. So anybody's guess what it's going to be. I haven't checked what the market is currently pricing in. I know when it comes to the ECB, I definitely err on the slightly dovish side just because they are in a difficult situation. So raising rates is something they are definitely doing begrudgingly. They do not want to do that. So if I had to guess, they'd probably do 50, but they maybe will be motivated to front load. Maybe they do 75, wait to see what happens, and then do the next one at 25 basis points, or who knows. So I'll have to look into it more, but I think both are definitely on the table. But yeah, like I said, I might lean more towards dovish, but don't listen to me. Not financial advice. Okay, next story. So this isn't technically, I guess, all that related to finance or global macro, but it is just because any developments in the Ukraine war or significant developments have serious implications for the energy market and just geopolitics in general. So I thought I would include it because it is kind of a big deal. So Putin mobilizes 300,000 troops for the war in Ukraine and warns he's not bluffing with the nuclear threat. So Russian President Vladimir Putin on Wednesday announced a partial military mobilization in Russia, putting the country's people and economy on a wartime footing as Moscow's invasion of Ukraine continues. In a rare pre-recorded televised announcement, Putin said the West wants to destroy our country and claimed the West had tried to turn Ukraine's people into cannon fodder, which I had to look that up because I had no idea what that meant. Basically just means expendable troops. He's saying that the West is viewing Ukrainians as expendable to pursue their own, I guess, cause or means of weakening Russia, which honestly probably isn't really that untrue. I mean, that's definitely I would say the assumption that the United States may say they're really trying to help Ukraine, but they obviously had their own interests at heart where they want to weaken Russia. That might be a bit aggressive, saying that they're willing to turn the Ukrainian people into cannon fodder, but still, fair point. Putin said mobilization events would begin Wednesday without providing further details, aside from saying he had ordered an increase in funding to boost Russia's weapons production, having committed and lost a large amount of weaponry during the conflict.
Little bitch.
So in what was immediately greeted as an escalatory address, Putin also accused the West of engaging in nuclear blackmail against Russia and warned again that the country had lots of weapons to reply to what he said were Western threats, adding that he was not bluffing. Putin has alluded to Russia's nuclear weaponry at various points during the conflict with Ukraine, but there are doubts over whether Moscow would actually resort to deploying such a weapon. Now, while I still think it's unlikely that they would use a nuke, one thing to keep in mind is that as this war bleeds into the winter, when foot combats are not really all that practical just because of the weather, the snow, and all that, I would say maybe the likelihood of using a nuke, just because it doesn't really matter if it's winter, you can fire a nuke. I would say that chance increases, not necessarily meaningfully. And it's obviously not a base case. Like I do not think that he would be willing to shoot off any nuke, but I still think it's important to keep this in mind because we are transitioning to a part of the war, just because of the seasons, where something like that is maybe more on the table than previously, just because other means of attacking or doing whatever are less on the table, just because you can't force, these 300,000 troops to, move through snow that is basically just impractical. It doesn't make sense.
Totally.
So financial markets reacted negatively to Putin's comments, with oil prices spiking more than 2% and the Russian ruble slumping around 2.6% against the dollar. I believe actually today the Russian ruble rebounded though to another, it was like up 1.5%. So, take all this with a grain of salt. Russian defense minister added more detail on the partial mobilization Wednesday morning, saying it would see 300,000 additional personnel called up to serve in the military campaign in Ukraine. Putin's comments come as Russia's invasion of Ukraine approaches the winter period, with momentum appearing to be on Ukraine's side after it launched lightning counteroffensives in the northeast and south to reclaim the lost territory. It's another thing to keep in mind that Russia and Putin have been somewhat embarrassed by the Ukraine's victories. Not overall victory, obviously, but these like small victories of taking back land and just kind of, humiliating Russia on the global stage a little bit. So that's not necessarily a good place to be when you're a quasi-unstable person with nuclear weapons. So again, another reason maybe the nuclear threat is a little bit more real than it was previously. All right, next story. So Japan posts a record trade deficit in August as energy imports soar. Japan ran its biggest single-month trade deficit on record in August as imports surged on high energy costs and a slump in the yen, exposing the economy's vulnerability to external price pressures. One thing that is, at least right now, not good for Japan is that they are basically they're so reliant on energy imports. They don't have that. It's a small island. They don't have that much energy domestically. So they are, now it's not 100% that they import, but it's close to, where it's like 90+% or something of their energy they have to import. So these energy prices are hitting them very hard. Now, the growing trade deficit highlights the fragile nature of Japan's economic recovery, which has so far largely remained intact despite a high price tag firms are paying for imports that is aggravated by the yen's slide to a 24-year low. Imports jumped 49.9% in the year to August, driven by costs of crude oil, coal, and liquefied natural gas, and causing the trade deficit to swell to 2.8173 trillion yen, or $19.71 billion. The biggest shortfall on record. Imports are on the rise as high raw material prices continued and supply disruptions eased, while exports are sluggish. So here's a little chart, again, for those who are watching, of Japan's record trade deficit, just showing the imports and exports both spiking, but the increase in imports is in large part due to the yen. That's, because you have to basically pay more to get the same amount because the yen's value has dropped by 20%. So you basically have to spend 20% more to get the same amount you were getting. And so that can increase, the currency denominated value of your imports. So oil imports from the United Arab Emirates and coal and LNG from Australia strongly drove up overall imports, so mostly energy. By region, exports bound for China, Japan's biggest trading partner, grew 13.5% year-on-year in value terms on stronger shipments of motor vehicles. Shipments to the world's biggest economy, the United States, expanded 33.8% in August, largely due to stronger motor vehicle and parts exports. Exports, however, declined 1.2% in volume terms, the data showed. And last bit, exports aren't growing on a volume basis, even though the yen has weakened so much. That will be hard for corporate profitability unless the global economy starts expanding and exports increase. So not good news for Japan. They are really getting slammed both ways. I mean, their currency is just, when you think about it, your currency is how you interact with all the economies. So if your currency is suffering, that is going to put pressure on pretty much every aspect of your economy. I mean, everything that you try to buy, import, is going to be a lot more expensive. So this has very, very wild implications, and this is why Japan is posting a record trade deficit. But before we switch away from Japan, let's talk about the record inflation. And now, when you say record, or not record, but 8-year high inflation, one thing to keep in mind is Japan's inflation has been really low, at least in the last 20 years. And so this record core inflation was 2.8%. So nothing compared to the 5.6 or 6.3% in the US, but still noteworthy. All right, so Japan's core consumer inflation quickened to 2.8% in August, hitting its fastest annual pace in nearly 8 years and exceeding the central bank's 2% target for a 5th straight month as price pressures from raw materials and yen weakness broadened. The strength of August inflation reinforced growing suspicions among economists that price pressures will last longer than the Bank of Japan has been expecting, though many still expect no immediate change to its ultra-easy policy.
You're a fucking idiot.
Yeah, so Japan, the Bank of Japan, is remaining steadfast in their commitment to easing, basically, and pinning rates at a maximum of 25 basis points. I think their interest rate is actually negative at minus 0.1%, but they are defending positive 0.25%, 25 basis points, which is a wild deviation or divergence from all the other economies. Central bank monetary policy. Like the Fed raising 75 basis points just today. And meanwhile, Japan is defending a maximum rate of 25 basis points.
Yep.
So the Bank of Japan will on Thursday, tomorrow actually, I believe they are expected to deliver their interest rate decision. It's either tomorrow or later today. Actually, it might be later today. So the Bank of Japan will on Thursday end a 2-day policy meeting at which analysts expected to consider the fragility of economic recovery and deciding to hold both short and long-term interest rates near zero. The weak yen is importing inflation into Japan. Core consumer inflation is set to top 3% in October. The increase was due largely to higher utility bills, rising food and grocery good prices. So the Bank of Japan's dovish policy stance contrasts with expectations that the U.S. Federal Reserve will on Wednesday, which again, this is, I guess, looking back in time. So this already happened, raised 25 or 75 basis points. So again, putting more pressure on that interest rate differential that is driving the yen weakness. But so on Wednesday, implement an interest rate hike that will widen a differential with Japanese yields and possibly trigger a fresh bout of yen selling. Now, I haven't checked since the Fed raised rates how the yen was doing, but I imagine there's a little bit of an increase, though it was mostly priced in. The expectation was 75 basis points, so currency markets probably already got that figured out. All right, the inflation data highlights the dilemma the Bank of Japan faces as it tries to underpin a weak economy by maintaining ultra-low interest rates, which in turn are fueling an unwelcome slide in the yen that pushes up import costs. The pain felt by households adds pressure on Prime Minister Fumio Kishida, whose approval ratings have plunged to deploy a fresh stimulus package to pop up growth. Got all these countries that are trying to fight inflation by issuing free money, subsidizing their economy. Doesn't really make sense. You don't usually beat inflation by throwing more money at your problems. No! But anyway. So with inflation still modest compared with the price rises seen in other major economies, the Bank of Japan has pledged to keep interest rates ultra low, remaining an outlier in a global wave of monetary policy tightening. Yeah, so we'll see how long they can really commit to that. I mean, as long as the Fed and other central banks continue to raise rates, that is putting increasing pressure on them to pivot themselves, just because the yen is only going to devalue even more. I mean, as those interest rates widen, or that spread between the Japan interest rates and the United States or ECB or whatever other interest rate, as those spreads widen, more people are going to flee the yen and dump their money into something like the dollar or whatever currency, just because the Japanese investors are getting starved of yield.
Totally.
All right, next story. Let's transition to commodities. So first commodity story, OPEC Plus supply shortfall now stands at 3.5% of global oil demand.
What?
So OPEC Plus is now producing below its targets by a record 3.58 million barrels per day, about 3.5% of global demand, highlighting underlying tight supply in the oil market, even as recession fears drag oil prices lower. Two main factors have been derailing OPEC Plus' ability to hit its production targets: a chronic problem with underinvestment among certain members such as Nigeria and Angola, and more recently, the impact of Western sanctions on Russian output. So Russia is one of the biggest, I believe they actually are the biggest oil exporter in OPEC Plus. I think they just barely edge higher than Saudi Arabia. So the sanctions are having a outsized effect on the oil market, as everyone already knows, but just reiterating that.
Nice.
Okay, the head of Saudi state oil giant Aramco said on Tuesday, continuing underinvestment in hydrocarbons at a time when alternatives to fossil fuels were still not readily available was the root cause of the problem. So basically highlighting this problem with the ESG narrative, how people are trying to switch to renewables like solar and wind without having them built out or capable of actually supplying us with the power that we need. So we're trying to abandon ship before we have our life raft built. That's basically the gist of this, which is totally true. The irony about, obviously not trying to endorse Saudi Arabia or anything, but the head, when they're talking about oil, that is their economy, right? So they know oil pretty well, and when they talk about it, they are being very realistic and rational. They mention how the United States and other Western nations aren't being very practical about this. They're not understanding the physics underlying commodity markets and how desperately energy is needed and the consequences of underinvestment that force us to contend with these higher prices or just not have energy. Energy shortages, because we're trying to transition away from hydrocarbons and oil, natural gas, coal without having the means to really replace them and maintain the economies that we have today. We could replace them tomorrow, but that would mean we have like a 90% less energy, which would be absolutely devastating. I shouldn't have to explain what removing 90% or 80% or whatever it is, even just 10% of global energy, reducing that, what that would do. Think about Putin just toying with the oil supply right now and how that's affected gas prices. That is not even anything close to what could happen if, Russia is about like 10% of the global oil supply, and that most of that is still on the market. So it's not like even 10% was removed, and that's just oil.
Not crazy.
All right, moving on. So it has been struggling for months to fulfill its quota. OPEC Plus, that is, has been struggling for months to fulfill its quota, and Saudi Arabia has made it abundantly clear that they would only use thinning spare capacity in case of real emergency. So I've talked about this before. Saudi Arabia is they've basically committed to keeping oil prices a little bit high. They are not, a big fan, to go figure, of oil going down, and they are not willing to increase capacity aside from emergencies. So despite Biden's pleas to have them increase their output, that's not really what they're in the mood for.
No!
Okay, let's transition. Next story. So this is a big deal. BlackRock's Larry Fink, who is the CEO of BlackRock, and for those who don't know, BlackRock is like the biggest asset management firm in the world. I'm pretty sure it's in the world. They have something like $8.5 trillion under management, and they a lot of people talk about BlackRock as an extension of the government, and what they say pretty much ends up being like the precedent for the rest of the investment world. So they were kind of the pioneers in ESG, and then all these other firms, hedge funds, institutions, yada yada, they followed suit, got in line. BlackRock sets the precedent. So them saying this is huge, because that basically means that the rest of the financial world will get the green light to view natural gas as green, which if they are trying to remain ESG compliant and natural gas is not green, that poses problems. So this is good news for firms investing in natural gas because it is consistent with ESG compliance.
Totally.
So BlackRock Chief Executive Lawrence Fink said on Thursday that natural gas would play a key role in the global drive to cut planet-warming carbon emissions, and praised the European Union's decision to label as sustainable some investments in using the fuel. It's funny, they weren't driven to this until they absolutely needed natural gas, and so they're like, oh yeah, we'll just say it's green, which it is greener than oil and coal. It's the greenest of the fossil fuels, but it is a fossil fuel, so it's just ironic that when push comes to shove, you do what you have to.
Yeah.
Fink said it was likely to be impossible to phase out hydrocarbons in the next 20 years. The key is going to be gas, he said, describing it as obviously less pollutive than other forms of hydrocarbons. Fink is very pleased that the Eurozone finally has said gas is green. Characterizing the shift away from fossil fuels as a balancing act, Fink also said energy companies should look to develop relatively new technology that aims to capture, use, and store carbon emitted from industry. Now, this has been a long hope of the, climate, both the climate people and to a certain extent the energy market. It's carbon sequestration, of them trying to pull carbon out of the atmosphere, because if you are polluting, you're sending pollution through hydrocarbon burning into the atmosphere, but you have a way of extracting that and taking it back. It doesn't really matter. We can use all the oil, gas, coal we want because we have a means of taking it out of the atmosphere. So, you can imagine energy companies would be very, very pleased if this was a possibility, but I believe the technology is nowhere close to where we need it to be. If, that's not an exaggeration at all. It's nowhere close. And especially to do it at scale, I don't think it would be practical, cost effective or anything. Obviously, you can get government subsidies. That might help that out, but still, it's not really practical at the moment. But that is a big hope of... I would say the world, because it kind of helps everyone. If we were able to develop some sort of carbon sequestration that could be implemented at scale, that would be basically kind of turn this whole ESG narrative on its face, because people will be able to use hydrocarbons as much as they wanted to, because you could just take it right out of the atmosphere.
My man.
So I think this is a last quote from Fink. I believe the major energy companies of the world today are going to be the leaders in sequestration of carbon. And that's probably for the reasons that I just said. How they definitely have a financial interest in doing that, because that means they can continue using hydrocarbons.
Yeah.
Okay, next story. So the British government, under newly appointed Prime Minister Liz Truss, plans to cut the wholesale prices that are incorporated into businesses' energy bills this winter. The report comes ahead of the government's energy support package for businesses, which is expected this week as the government resumes its duties after a period of national mourning for Queen Elizabeth.
Aww.
Earlier reports said that the support package to help businesses facing high energy bills would cost the government roughly £40 billion, or $45.4 billion. The
You're a fucking idiot.
The Bloomberg story, which cited people familiar with the matter, said prices would be capped at about 21.1 pence per kilowatt hour for electricity and 7.52 pence for gas. I wish I knew what that conversion was, but sorry. So the discounts are set to apply to contracts signed since April 1st this year and would last 6 months starting October 1st. So this is, I would say, good in the short term, because a lot of these businesses are not going to stay alive if they have to pay what is the market price for energy. But the problem with price caps like this is someone has to pay for it, and that is the government in this case. And basically what they're doing is they are suppressing the price. It's a price control, an all but name, I suppose. They are, capping prices at a certain level, price cap. And what that means is people are probably going to be using more energy than what would normally be allowed because the price would be too high for them to afford, and so they would naturally curb their demand. And what this means is you're probably going to have shortages because if we're already in an environment where energy is scarce, and that's why prices are going up so aggressively, then they're going to with the price cap, basically businesses are going to be able to use more energy than they otherwise would, thereby increasing the decreasing the supply because they're increasing the demand artificially, increasing it farther than what the normal market price would allow, which I guess wouldn't really allow much of any electricity consumption. So it's kind of hard to say because it makes sense. It's not these businesses' fault, and a lot of them would just go under because they can't afford electricity. But at the same time, this isn't going to help the problem. I would say it's potentially only going to exacerbate it because it will exacerbate the shortage by increasing demand by not having it reflect the natural market price.
Totally.
But I digress. We'll probably see more companies, or not more companies, but more countries do this as well. I think all across Europe, you got a lot of places implementing price caps. I think a lot of places already have them implemented. So, like I said, not necessarily a good thing. Could exacerbate shortages, might help in the short term, but in the long term, probably won't help the problem all that much. Probably even make it worse. Aww. But anyway, next story. Okay, so we're transitioning to crypto. And this is kind of a big deal. So the White House released its first ever comprehensive framework for responsible development of digital assets. Now, the big takeaway here is going to be CBDCs. I think the next story that I have is also about CBDCs, but there's definitely a lot more to it, so I'll just get into it. The digital assets market has grown significantly in recent years. Millions of people globally, including 16% of adult Americans, have purchased digital assets. So 16% of Americans adult Americans have purchased crypto, which is pretty crazy.
Nice.
Probably mostly Dogecoin and Shiba, but what are you going to do? Digital assets present potential opportunities to reinforce U.S. leadership in the global financial system and remain at the technological frontier. But they also pose real risks as evidenced by recent events in crypto markets. The May crash of a so-called stablecoin, Terra Luna, and the subsequent wave of insolvencies wiped out over $600 billion of investor and consumer funds.
God damn!
So that's really what catches their interest. I mean, when people start losing money, obviously there's a lot of blowback, so they start to step in. So over the past 6 months, agencies across the government have worked together to develop frameworks and policy recommendations that advance the 6 key priorities identified in the executive order: consumer and investor protection, promoting financial stability, countering illicit finance, U.S. leadership in the global financial system, and economic competitiveness, financial inclusion, and responsible innovation. The reports call on agencies to promote innovation by kickstarting private sector research and development and helping cutting-edge U.S. firms find footholds in global markets.
Totally.
At the same time, they call for measures to mitigate the downside risks, like increased enforcement of existing laws and the creation of common sense efficiency standards for cryptocurrency mining. Recognizing the potential benefits and risks of a U.S. central bank digital currency, CBDC, the reports encourage the Federal Reserve to continue its ongoing CBDC research, experimentation, and evaluation, and call for the creation of a Treasury-led interagency working group to support the Federal Reserve's efforts. Now, that was a mouthful, I know, but like I kind of mentioned in the beginning, the key takeaway here is the Fed and the government more broadly is getting very serious about a CBDC. They basically all but committed to making one. I think they're just working on the technology side, trying to figure it out, but they have pretty much committed to one. And I won't spoil it because the next story gets into it more, but this is a big deal. And they're basically embracing the technology of crypto without embracing actually crypto. They want to create their own, of course, because they can control it. So the reports encourage regulators like the SEC and Commodity Futures Trading Commission to aggressively pursue investigations and enforcement actions against unlawful practices in the digital asset space. So they're trying to crack down. To make payments more efficient, the Federal Reserve has planned the 2023 launch of FedNow, an instantaneous 24/7 interbank clearing system that will further advance nationwide infrastructure for instant payments alongside the clearinghouse's real-time payments system. So the Fed now is basically the system, the infrastructure for the CBDC. That's what they're calling it, the Fed now. So if you hear that, just know that's basically, for lack of a better term, synonymous with CBDC for the Fed. So digital assets and the mainstream financial system are becoming increasingly intertwined, creating channels for turmoil to have spillover effects. So this has been one of the big concerns about crypto as it gets bigger is contagion. If crypto blows up, is that going to have implications for the overall financial system, or at least the US financial system, because of overexposure to something like Terra, and then that creates like margin calls, or just you having to sell assets in the equity market or in the treasury market to counteract those losses you have in crypto. So this has been a big consideration, is whether or not the crypto market will lead to contagion. And so that's why there is this emphasis or motivation to regulate it, to protect, right? So in October, the Financial Stability Oversight Council will publish a report discussing digital assets' financial stability risks, identifying related regulatory gaps, and making additional recommendations to foster financial stability. All right, here we're getting deep into the CBDC part. So a US CBDC, a digital form of the US dollar, has the potential to offer significant benefits. It could enable a payment system that is more efficient, provides a foundation for further technological innovation, facilitates faster cross-border transactions, and is environmentally sustainable.
My man!
Get this out of here. What is this? All right, so a potential US CBDC could also help preserve US global financial leadership and support the effectiveness of sanctions. There it is, right? The CBDC is going to give them full control, basically, of the monetary system. They don't have to, affect money or affect monetary policy through like bonds or like primary dealers by, buying and selling bonds, quantitative easing, tightening, all that stuff. They can affect the money supply directly because they basically control the ledger entirely. It's not this kind of outdated version that we have today of this old system. It'll be updated. They'll be able to completely, just manipulate everything if they want. I mean, they don't have to, obviously, but that door is open, and that's kind of the problem. So they do like that, and they might say help support the effectiveness of sanctions, but that means on everybody. I mean, they can sanction anybody at any moment, just like that. They can take money out of your bank account. They can put money in. It may make something like taxes a little bit more streamlined, which is, there are some benefits to it. But privacy is very much, very likely out the window. Aww. So recognizing the possibility of a US CBDC, the administration has developed policy objectives for a US CBDC system, which reflect the federal government's priorities for a potential US CBDC. The administration encourages the Federal Reserve to continue its ongoing CBDC research, experimentation, and evaluation. So you heard it. They're basically, and this is from the White House. They're encouraging the Fed to go forward with their CBDC research. So I mean, hard to say when this would actually happen. They're definitely going to take their time in implementing it until they get it right. They're not going to just jump into it. I think Powell said that before when he was asked about it. He said, because the U.S. is the global reserve currency, them taking their time to get this right is very important. But there are a lot of pressures right now, which is a good segue into this next story, that are leading high-level officials or the government in general to encourage a CBDC, and that is primarily to compete with China. So U.S. digital currency, a unanimous need to compete with China, according to the House Committee. So 5 speakers at a hearing for the U.S. House Committee of Financial Services voted in favor of the U.S. developing some kind of national stablecoin or CBDC on Tuesday, citing competition from China's progress on its digital currency.
Little bitch.
So China's been working on its digital yuan for some time, and I think they're actually planning on rolling it out pretty soon. And a lot of people are saying that is to compete with the United States directly, basically create an alternative to the dollar as a a new global reserve currency, potentially. Obviously nowhere near there, but this is a good step because there are like a lot of streamlined benefits to using CBDCs, and that is, you don't want to give China the ability to manage your transactions like that, but the digital yuan does help. There are a lot of benefits to it that people will be encouraged to use it. So that does potentially, creates one potential advantage that the Chinese Chinese currency would have over the United States and the dollar. So this is a big reason why people are encouraging the United States to get going with the CBDC. So Guam House Representative Michael San Nicolas, sounds like a saint, Michael San Nicolas called for an on-the-record vote among the panel of witnesses in an effort to gauge the level of necessity for the U.S. government to establish some kind of digital currency like a CBDC. All 5 speakers agreed that there was a unanimous need.
Damn!
While the vote was simply to clarify the panel's position, the hearing and its key takeaways indicate that there is a strong chance a CBDC is on the horizon. Just a few months ago, Federal Reserve Chair Jerome Powell said such an invention would be a very important financial innovation and is something we really need to explore as a country.
Say what?
Why should the U.S. government consider its own CBDC? The committee cited international sanctions, a desire to protect the value of the U.S. dollar, and threats to national security. Specifically, Republican Congressman French Hill of Arkansas, I'm sure he knows all about CBDCs, said that the U.S. must take measures to ensure the U.S. dollar remains the reserve currency of the world. Speakers at the hearing expressed concerns around the threat of China's growing financial presence as a rival to the U.S. economy. And according to Professor Norloff, China, I don't know who Norloff is, but just go with it, China is developing its own CBDC precisely in an effort to compete with the US dollar. China is trying to catch up to the United States, and they are using various methods to try to catch up. For China, it's crucial to create a CBDC in order to get anywhere close to where the US dollar is today. While America debates the merits of creating its own CBDC, China is moving ahead with its CBDC trials. The South China Morning Post reported Tuesday that the People's Bank of China will begin testing out its new digital version of the Chinese yuan, eCNY, in 4 additional Chinese provinces. But it's not just China, or it's not just a China issue. It's a general issue. There are about 104 countries currently exploring CBDCs.
Not crazy.
Now, China is obviously the one we care about the most because they're the only country that has any realistic chance, a small chance of replacing the US dollar or, at least matching its power. Again, I don't think this is really possible. I think the dollar is going to be the global reserve currency for a long time. And I personally don't think China they're in too much economic turmoil right now, and their future looks too bleak with demographics and all this stuff that I don't think it's really a problem. But if anyone were to dethrone the United States and the dollar, it would be China. So even though there are about 104 countries currently exploring CBDCs, that doesn't really matter all that much to the United States. But it still is a testament to the rest of the world evolving and kind of embracing this technology because it really is better. Again, you have like these privacy concerns, but the advantages of having this digital ledger and just solving the double spend problem with blockchain technology is huge because it creates faster settlements. Imagine right now when you settle currencies, it can take days for it to clear, and you have to do it during normal operating hours for banks. You can't do it on holidays and weekends. It doesn't make sense. In this new digital world, being able to send money anywhere pretty much instantly, 24/7, 365 makes sense. It's possible. That's how Bitcoin works and other cryptocurrencies. And so there's no reason that the other currencies, like the ones that most people use, like the dollar, the yuan, etc., that they aren't also at that same place. But we'll see. So anyway, moral of the story, CBDC on the horizon, and we'll probably see Fed now. Hard to say when it's going to be released, if ever, but maybe within the next year. So pretty crazy stuff.
Yep.
All right, that does it for all the stories for this week. But before I get out of here, let's touch on what to look out for in the week ahead.
My man.
Starting with later today, we have the Bank of Japan interest rate decision. The forecast is to keep it at minus 0.1% and maintain its commitment to defending its 25 basis point cap through yield curve control.
You're a fucking idiot.
And tomorrow, the Bank of England delivers its interest rate decision. The current rate is 1.75%, and the forecast is a 50 basis point hike to 2.25%. And this Friday at 8 a.m. Eastern, Fed Chair Powell will be giving another speech. And next Tuesday, U.S. durable goods and new home sale numbers come out.
Nice.
And then finally, I will be out of town, unfortunately, next week, so there will be no Hump Day update. Aww. But in the meantime, I hope you find your news somewhere else. And always remember, stay happy, humble, and most importantly, solvent.
And we say bye-bye.